global but local attorney, and we're really excited today to share with you one of our guest speakers that we brought in to talk a little bit about the mortgage industry. I know a lot of our community is interested in investing in real estate, and we've talked a little bit about whether it's multifamily or single family or what kind of investments make sense. So one of the critical components of that is the lending side. So I wanted to bring in an expert, Mr. Brian Lehman, who's going to talk to you a little bit about how that works and what you need to know when you're looking at the lending side of the equation. So Brian, tell us about yourself.
Yes, I'm a native of Baldwin County. I grew up in Summerdale on a farm. I've lived all over South Louisiana and South Alabama. Graduated from the University of Alabama. During my time, I've covered a lot of different programs with folks. I've worked as a lender for many years. I've also worked in financial services in the past. My job is to actually try to help people get where they need to be in life. I'm not a financial planner or things like that. I'm an actual true mortgage lender.
Great, that's great. Well, and one of the reasons I think we wanted to hear from you is that, you know, the average person, including the folks in our community, they're going to decide between do they buy their own house or do they rent and then put money in investment property. What are some of the lending differences between buying your own house that you live in and buying a house for an investment property?
Good questions. Buying a personal property, especially in Baldwin County, you can get deals down to up to 100%, whether it's VA, USDA.
Wow.
There's even actually a program with FHA where we have this called Chenoa, and Chenoa will help a person cover their 3.5% down payment. Now, if you have to go or want to go conventional, if you have a score of 680 or above, and especially if 720 or above, there are some programs where will keep your rate very low and keep your mortgage insurance, which you have to have on any loan of greater than 80% loan to value, and that's important, loan to value, 80%, where you can have as little as 3% down payment. So, and with that, and you can have discount MI and rate.
Well, let's talk a little bit about credit score. So a lot of our folks have no credit score at all. They're young people. They are now kind of deciding, do they go to college? Where do they build credit? How do they build credit? Because you said a score of, 680 is what they're looking for some of these loans. What would you tell them about, kind of looking at your credit score, finding, getting a credit score and building your credit score?
One of the things, there are a lot of avenues. And typically, if you're down to 580, we can still possibly get you into a home loan. Now, we prefer you to be 620 or above, but it's one of those things where there are options. Even below 580, there are some options. It depends on the person's situation, if they've had a bankruptcy.
What if they have no credit?
Which is actually quite common. No credit sometimes is better than bad credit.
Because I've heard the opposite too. So it's funny, that's interesting that you say that.
Well, we can build your credit, and what I do, and if some of the other lenders will actually try to help the borrower or buyer, help them build their credit. Say somebody has no score, we can give you avenues to approach to try to get your scores up fairly quickly. Now, your typical lender kind of looks at you and goes, oh man, that sucks, good luck. So that's, we're here more for the service of the people. We want to be your lender for life, as opposed to something where one and done by.
Right. And I think that's an important point. I think a lot of times, since the crash of 2008, the lenders are kind of looking a little more adversarial to the borrowers in a lot of ways, because the criterion, I think, has been stepped up at this point, right? Because there was a lot of, as we just talked about before the interview, a lot of things that happened in 2008 that precipitated the crash, and then there was, of course, a correction in the industry. So now they're to me at least, some of our folks are going to banks or going to lenders, and they're kind of getting the, it's not going to happen look. So we want to kind of help them figure out where do they go, how do they navigate through that.
Good point. One of the things people need to be aware of is 2007, 2008, 2009, yeah, it was extremely hard to get a loan. But as time progresses and rates go up a little bit, every time things change, it gets a little easier for the client. And you can expect that to keep going. Matter of fact, one of the things buyers typically are worrying about, and shouldn't be, is they're saying, well, it's no longer 3% interest rate, it's no longer 4%. That's true. But in this country, the average interest rate ranges between 6 to 8% from time immemorial. And if you're old enough to remember the 80s, it got up into the 18% range for a lot of folks, and that was tough to carry. So, as a matter of fact, one quick tidbit for you. If you're watching this and you're thinking, well, prices of houses are going up. Yes, they are, as are rates, which means as the rate goes up, you can buy less house, which makes this a very spectacular time to actually be buying a property, because you're getting rates you will more than likely not see again. Because I assure you, that being in the fours as we are at this particular moment is not something we expect to come back.
Yeah, that's great. That's a great rate. And that's on the residential side. So what that means is your house that you live in, you would have to live in that house, correct? That would not be an investment property.
For what it's worth, first and second mortgage are going to be very close to the same rate. An investment property depends on what it is. It could be as little as an eighth higher than your
Really?
primary residence, but it could be higher. It depends on what you're buying, where you're buying. If you're looking at a condo on the beach, expect to pay a little bit higher because they're under a different set of rules and guidelines than a house. If you're buying a single family residence in Foley, Mobile, Pensacola, wherever, there's another set of guidelines then.
Okay, why is that? Why are there different guidelines for those?
Part of it's because when everything crashed and burned, the beach condos took a mass beating,
Because they were more second homes or investment property.
mostly investment properties. So nobody was really willing to write them.
Right.
So what's happened is you can be off the beach in a condo and be looking at one set of rate and rules, where if you're right on the water, your rate is going to be probably be a little higher. Not always, but probably a little higher. And you're also, just as a tidbit, more than likely if you're buying an investment property, you're going to be putting 25% down payment on that property. And if you wonder why, ask a CPA and they can explain to you how you want to typically have 25% into a property so you're actually making money on it.
Well, that's a good point, because when you run the numbers on an investment, you have to make sure that your ROI makes sense. So again, that's some people think, well, I don't want to put any money down. Well, that's fine, but it really affects your calculations. So I think that's a really good point, to make sure that you're putting as much as you can down, because
Correct.
that is going to definitely affect your ROI on a single family. So back to the single family homes, because there's a debate kind of, is that a good investment? And I think my personal view is if you're going to live there, fix it up, and then flip it, potentially that's the way to go. Because one of the things that we've seen, at least in my career, is when you buy a house and you have a mortgage payment, and then you have an office with a rent payment, that's a lot of payments. So are you able to bring in enough cash flow to support two homes, if you will, your professional home, and this is if you're self-employed, which a lot of our folks are. So are you able to do that, and how? And what are your allocations looking like? So I think if you could sort of buy your home and then fix it up, especially in communities like this one where there's really lots and lots of product, is that a way to go? Is there a good strategy on the lending side to do that? Because some people, will just do an all cash buy. Some people will do a leverage buy. What are you seeing in your marketplace in that regard?
It's interesting that you bring that up because we're doing a lot of renovation loans. And what a renovation or a rehab loan is, you buy a house and using easy numbers, say a gentleman or a lady buys a house down the street here and they buy it for $100,000. Well, they know on the front end, because they've talked to contractors or gotten bids, and it's going to cost them another $35,000 to rehab that house
Right.
to a decent level where it'll gain value. In a case like that, you can get a rehab loan, and if you're planning on living in it, you can get an FHA rehab or a conventional rehab, and with FHA you can have as little as 3.5% down payment. That 3.5%, say again using these numbers, you buy it for $100,000, you put $35,000 worth of repairs into it, and then once you're completed and you're ready to move on, say you can sell it for $180,000. Well, as you can see, you're netting out fairly well.
Right. Now let's take the scenario where it's just a straight up investment. So you're just buying a home, you have your own home, it's over there somewhere, but you're looking at the community and you want to buy some investment, single family homes. What kind of down payment would be required? What kind of interest rate do you think you would get in a place like Baldwin County at the moment? Which is just maybe is a typical community, I don't know.
Yes, normally if it's a known investment, you're going to have to put 25% down. The reason for that again is the investor wants to make sure you can make money on this. They're not in it as a game. They want to make sure if you buy this house, you're going to turn a profit, and they want you to keep going. They want you to have the ability to keep buying more and more properties. Again, if it's something you're buying as a primary residence, it's a little different set of rules. Or if you're buying as a second home actually, it's lower down payment requirements.
Okay, because there's some different tax consequences on that one as well, second home
Yes.
ownership. What are you seeing in your applications? If you could kind of say, please don't do this. What are some of the things not to do when you're trying to apply for a mortgage?
Don't buy anything. And I mean that most sincerely. What?
I tend to agree. We've just been to a conference that they said literally rent the place you live in, because buying is, maybe not such a great idea. But anyway, proceed.
Well, the key is people want to go out and they say they're buying a primary residence or they're buying a residence to rehab and put stuff in. Well, they'll say, well, I need a refrigerator and I need a couch and I need this, that, and the other thing. Well, there are times people put their debt to income ratio right over the lip. And once you go over the brink, you're done. So the lender comes back to you and says, I'm sorry, you can no longer afford this house. You are now out.
At what point? How do they know that you've gone over and spent too much at the furniture store or the appliance store at Home Depot or whatever?
Here's a little thing people don't realize. They think they'll never find out. I went down to this little furniture company. It's a small furniture company. Yeah, and I just told them, I just want to buy this couch, hold it for me. The furniture company said, okay, well, yeah, they asked for my social, but no big deal. But what happens is, as soon as they run your credit, because they're going to run your credit, if they're giving you any type of loan whatsoever,
Yes.
as soon as they run your credit, Fraud Guard pops up and says, hey, Angela just bought this something worth $10,000. Well, that goes straight into your debt to income ratio. And if you're sitting anywhere close to 45% debt to income ratio already, you're done. Because if it
Which
crosses,
means you will not be eligible for a loan at that point.
correct.
Wow.
And you did it to yourself.
Yeah.
And
Well, and that's also a hard pull. Explain to them what a hard pull is on your credit, because those are fun. When you go, I just bought a car and they did 6 hard pulls on my credit. That was pretty hard.
and that was one lot.
Right.
What happens, hard pull, and people get confused for this, just like I said, Fraud Guard tells us if you go get a second pull somewhere, a hard pull is one of those where you're trying to get scores, you are actively pinging, trying to buy something. Now, a soft pull is one of those where we're monitoring you. It's not telling us anything about your scores.
That's more like your utility companies
Yes.
and some of the other, they may be an application for an apartment loan or apartment lease or something like that.
Correct. And what they'll do is it's noted that, okay, they're getting a cell phone, and a cell phone will show up and things like that, but the power bill won't. But all they're doing is just trying to make sure that you're a good risk. And so it does not typically affect your scores unless you already have bad scores, then it could start affecting you. And by bad scores, I'm talking about high 500s and down. So,
Okay. So going back to your statement, don't buy anything, does that mean don't buy cell phones and cars and toys, or does that mean don't buy houses?
it means don't buy, if you're buying a house for whatever reason, don't go buy anything else. Don't buy a car, don't go buy a boat, don't go buy a Kawasaki Mule.
Get the house first.
Get the house first, because it's like this. If you go buy that $75,000 Dodge Ram truck, I hope you can live in it.
Well, you probably could in a Dodge Ram truck.
Probably so.
At least in Alabama, that's probably okay. All right, anything else what not to do, kind of when you're talking to a lender, or how to prepare for the meeting with you to make it more productive?
Very good question. One of the things, big mistakes people make is they try to hide stuff from their lender, and that's the exact opposite
That's the
direction.
American way, isn't it? Hide stuff from the IRS, hide stuff from the lender, hide stuff from your parents.
Well, the thing is, if you tell the lender on the front end, I've got these known issues, the lender will work with you and try to help you fix it. But if you hide it to the back end,
Right.
the underwriter looks at it and goes, why were you hiding that? And that's a reason to kill the deal. That's why always tell your lender everything. And I don't mean necessarily that you got divorced in 1997. I mean things that you're doing now. And if you have something in your background, like we had one gentleman, he owned a property in Illinois and he gave it away to a lender in lieu of a foreclosure, and it actually acted as a foreclosure. Well, he didn't want to tell us about it. Well, we found out about the hard way, and we were still able to close him. We just had to wait for the appropriate amount of time to pass. And thankfully, in his case, the seller was willing to wait with him for that time to pass.
Well, that's interesting. Yeah, I mean, we are not a saving culture. The United States does not save money like the Japanese, for instance, or some of the other Western European countries. So we tend to live close to the edge. What is the statistics on, either paycheck to paycheck, or maybe you don't even make it to the end of the paycheck, when your bills are still due. So when they're coming to you, you counsel them, you advise them on, okay, here's where you are now, and let's get you back in 6 months. Here's what you need to do during that time period.
Yes, matter of fact, can I tell you a real brief story? I had 2 clients that they both made a great income. I mean, they weren't making $1 million a year, but they were both making well into the 20s an hour. And they had no debt whatsoever, but they also had no money in the bank. And that was an issue. Because if you make that kind of money, you should have enough for a down payment. The problem was, when we got down to it, they very much enjoyed going out to eat. They very much enjoyed their rum. They enjoyed having a very social life.
Well, that
which
sounds
is,
pretty enjoyable.
except you can't buy anything because you had no money for a down payment. Now, we did work our way through it and get them into a house and closed, and now they're enjoying their life,
Right.
even more so. So, just a tidbit.
Right.
Don't, if you can, save at least 10%.
Discipline yourself.
And that's just it. You'd be shocked.
It's not in our nature. Human nature does not support that.
After 2007, you would have thought a lot of people would have learned that lesson because so many people
It
were
was a
injured
long
by it.
time ago, though. People forget.
But unfortunately, they did forget. And a lot of our young folks now, with that being said, 3 of the best loans I've ever done were young folks who they were disciplined. I would ask them for something and they would have it back that same day or the next day. And the loans closed early, one of which closed in 15 days, which is fast
That's
for
fantastic.
a mortgage.
Right.
So,
Well, how do they get in touch with you? We appreciate you being here. So if you want more information, how would they reach the Lehman Brothers? Just kidding.
well, the direct dial number is 251-752-2262. That number again, 251-752-2262. Also, the email address is blehman, BLEHMANN, @USA-mortgage.com. And there's actually, if that email is too long for you, I'll give you another one that's much easier. Gulftel, GULFTEL, the number 0, the number 2, @gmail.com. That pops into my email instantly, and I'll be glad to respond to you. And you're going to have questions, you're going to have concerns. I'm here to help. Call. Because if I can't help you, my job also is to try to help you find somewhere else that you can still get it done. And
Exactly.
I've partnered up with a lot of different other lenders to try to help people fix their issues.
Well, that's great, and we appreciate it because one of the things we tell our community is, build yourself a power team. You're going to need legal support, you're going to need accounting support, you're going to need lending support, insurance support. Build your power team, trust your advisors to tell you what you need to do, implement those suggestions, and that's how you become successful. So for that, that's it for today. We appreciate you guys being here. I'm Angela, your global but local attorney, and Brian, thank you so much.
Thank
We'll
you.
see you next time.
Thank you for watching this episode of The Hotspot, your community for success. Be sure to like and subscribe, and we'll see you next time.